Good afternoon, everybody. Or I should say good morning. This is Stevenson Lindor here. I'm going to go over a quick and simple way for you guys to understand flag formations. I've been getting a lot of questions and inboxes and messages asking me how do I locate and understand flag formations, how long does a flag formation go, so on and so forth. So I'm going to just do this quick video, answer all your questions here. And we're gonna get right to it. So I'm gonna go on Great Britain Japanese pair, right? This is a very common pair that a lot of people love to trade, right? Because it moves a lot. So this is what you're really looking for with flag formations. And this is what you need to understand. The market cannot go in one direction just like that. Pullbacks must happen, right? As you can see, when you look at your typical chart, you don't see just price going in one direction, whether it's on an uptrend or a downtrend, right? You have three directions, pretty much up, down, and it moves sideways, consolidation, right? During that consolidation period, a lot of times it's called a corrective move or a flag formation, right? Or a lot of times where price is just consolidating, waiting for the next big move. So how you locate flags, right? So the thing is, price basically, it's kind of like it's exactly what it is, a flag. Price goes up in one direction. So this is a perfect example. This is your pull, and then you get the flag, the pullback, right? And during that pullback, the market is basically gathering, right? It's gathering up enough, basically enough, contracts, enough, millions of dollars that's being consolidated in here, getting ready for the next big move up, right? So as you can see, flag, pull, pull back, and then next pull. Now, how long does a flag run for? It all depends, right? It all depends on how big the initial impulsive move is, right? So for example, this was a pretty decent move, right? So the flag formation, the pullback, basically all these little candlesticks inside here, right, was relatively short, all right? And you don't get in for the buy or the sell until basically price breaks above that flag pole, right? So if this pole right here, let me show you guys again. This was the initial leg before price started going up. So price is not going to break out. You don't really buy until price breaks out of this pole, right? So you got a nice bullish engulfing candlestick. So anywhere up here, you could have bought, and then you have a nice move back up to the upside. As you can see, another small flag was formed here, right? Because the move wasn't that big, the pullback wasn't that corrective, right? And then you got the next wave up, all right? I'm gonna show you another example, right? So as you can see here, this is another flag. This is actually a bearish flag. So it came down, right? And then you got your pullback. Boom, right? If you notice, this is a little longer than this bullish one, right? Why? Because the pull, right? The impulsive move to the downside was pretty big. So the flag was pretty big. So again, you're not really getting in to the market until price pretty much breaks out in a strong impulsive move. Or what I like to look for is a strong bearish engulfing candlestick. So kind of got one right here, right? And then you finally got the move down. So once you would have seen an impulsive move like this, you would enter on the next candlestick, depending on what time frame you're entering. Your stop loss is above that previous pole. So outside of the flag. So this is the flag right here. This is the pole. So depending on your account size, you can have your stop loss above the flag or above the pole. All right. Depending on your account size, depending on what you're targeting, right? If you want a small stop loss, it'll be above the flag. If you want a big stop loss, it'll be above the pole, right? Same thing over here. If I'm entering a buy, I could have entered a buy around here. My stop loss could have been here, or it could have been at the low of the pole. All right, so you have two options there. Now, because I'm a big long-term trader, so I trade off the higher time frames, you'll get bigger flags, right? So as you can see here, this was a big move to the upside. And then you had your pullback, right? So a lot of people would think, well, we're in a downtrend. No, we're actually in an uptrend because this was the big impulsive move up. So this downtrend was actually the flag setting up for this next wave up, right? And then you had another one again, setting up for the next wave up. All right. So my point is, every time you get in the market and you're looking for a buy or sell, understand a pullback is eventually going to happen. Price cannot go in that same direction over and over. I remember during the week, one of the pairs that I was really looking to trade was Euro CAD. And as you can see, we were pretty much at the high of, you know, a major supply resistance area. So price broke above it, right? It broke above. But look what happened right before the market closed. A major pullback, a major pullback. Again, price cannot take off in one direction without corrective move, without a flag move. All right. And you'll see this all over. So you'll see impulse, flag, pullback, and then continuation. A three-part move. Impulse, so basically a strong move in one direction, basically a pullback, a flag, and then impulse again. You see that everywhere, all right? At first, if you're brand new, it's going to be hard to spot. But once you train your eyes, it's like looking at patterns. Once your eyes start to, you know, see it more and constantly over and over again, you'll be able to spot it. So you have another one up. This is a bearish flag. Impulse, flag, pullback, and then continuation, right? So you enter at the impulse of the breakout on the flag, stop loss either above the flag or above the pole, and then boom. All right. This would have been a small continuation on this flag. So clearly, once you would have gotten profit, you moved up your stop loss to protect your profit. If price retrace, boom, you got a break even trade, right? And then you see it here. Impulse, small flag, then continuation. Impulse, small flag, then continuation. All right. And the market does this pretty much 24/7. So when we were in this pair and a lot of people were panicking because price jumped up and it kept going, like I said, a pullback must happen. So just to give you a little insight, you already know because of the strong impulsive move, we're going to get a pullback and then continuation. Now, for those who are asking, well, how do you know the flag is still valid, right? What if it keeps pulling back, pulling back? A flag is invalid once, right? Once the flag surpasses the pole. So this being the pole, the first impulsive move, if price breaks above here, above that high, then the flag is invalid, right? So same thing over here for this uptrend, right? Let me find you a bullish flag. So you have one right here. Let me go on a smaller time frame, see it better. Bullish flag. So perfect example right here. So this was your impulsive move up. This was your flag. So if price kept dropping and pulled all the way back down here, then the flag is null and void, right? So that's why you don't get into trade until the breakout happens. So once you see this bullish candlestick, that's why I love the engulfing candlestick, because it's letting you know that this is the direction price is going to go. Then you could have gotten for your buy, and then you got a nice move up. But then again, same thing. Impulse, pullback, continuation, pullback, continuation, bigger pullback, and then boom, bigger continuation. All right. So guys, it's really simple. Quick video, just going over flag formations as far as entry, stop loss, knowing when to get in, when to get out. All right, real simple. And if you align this when utilizing supply and demand, and for all those who are always wondering how do you locate supply and demand, I have other videos on this, but quickly go over here. All right, whenever you're looking for supply and demand, you're looking for strong bullish or bearish engulfing candlesticks. All right. So if I'm trading off the daily, and you can really find them on your daily, your weekly, even 4-hour time frame, right? You can find them on all time frames, but they're best to find them on the higher ones because they produce more pips, right? The name of the game is to get more pips. The more pips you get, the more money you'll make, right? So what you're looking for is like a bearish or bullish engulfing candlestick. So this being a resistance line, right? Boom. All right, so I got my bearish engulfing candlesticks here. So this would be considered a supply zone. That means once price gets anywhere around here, look for price to drop. So as you can see, and based on the size of the zone, that means anywhere, once price pretty much enters here, you can place your stop loss outside of the zone, right? And as far as take profit, you can trade from zone to zone, kind of like trading from support and resistance. So if this being resistance, supply, my take profit would be, well, where's the next demand zone, right? My demand zone's right here. I got a bullish engulfing candlestick, a big move to the upside. So this would be considered a demand zone, and then I would trade here. So my take profit from selling inside of here would be all the way down here. Now, again, if you would have sold here, you would have been fine. If you would have sold right here, you would probably got stomped out because this made a higher high. But as you can see, price came back down, right? So once price came back down, you could have entered again, and then your take profit would be all the way down to this demand zone right here. So real simple. I'll show you again on another chart. Euro USD, right? All right. So for example, we had all this support, basically supply and demand. So this being an area of demand, why? Because you have your bullish engulfing candlestick here. So as you got the big move up here, when price came down, it went all the way up. And prior to this big breakout here, you had a supply zone here. You had nothing but bearish engulfing candlesticks. Now, just like support and resistance, after a while, price is going to break through. Right? It's going to create a new high, new low. So once price broke here, you wait for the retest. So you don't get in, you wait for the flag. The flag was formed here, right? On a bigger time frame on the weekly, pull back, and then boom, you got your breakout continuation, right? So just understanding your supply and demand zones and understanding your flag formations, it's going to make trading a lot easier for you. So again, you got an impulse, flag, then continuation, right? Same thing down. You got an impulse, flag, and then continuation. All right. So guys, just wanted to shoot this quick video showing you ways you can find flags and also spot supply and demand zones. Always look for strong engulfing candlesticks moving in that direction, and you'll see that trading will be a lot easier and simple. All right. So thank you guys for hopping on, for watching. I hope this video was helpful. I'll see you next time.